I know what I'm about to say sounds too simple to be true, but as someone who reached financial independence in my 30s, I can tell you, wealth isn't built by complexity, it's built by consistency. This is the exact 4 ETF formula I used to quit my job, and it is the exact formula I still follow today. But I want to tell you a secret. You don't need to be a genius to build wealth, you just need to follow a boring, repeatable formula. I call this the Fortress Portfolio. It is designed to survive crashes, capture global growth, and generate income while you sleep. It only requires 4 specific assets. So, if you are ready to stop guessing and start building, hit that like button to help this video reach more people. Today, I am breaking down the exact 4 ETFs I am buying in 2026. And make sure you stick around to the very end. I'm going to reveal a 5th bonus investment that has been quietly generating me an 11% return each year, completely outside the stock market. Let's get into it. Chapter 2. The Foundation, VTI. Every skyscraper needs a concrete foundation. If you don't have this, the whole thing topples over. For your portfolio, this core investment should likely make up more than 50% of your total net worth. We are not trying to find the needle in the haystack here. We are just going to buy the entire haystack. Asset number 1 is VTI, the Vanguard Total Stock Market Index Fund. When you buy a share of VTI, you aren't betting on one CEO or one product launch. You are buying a piece of the entire American economy. You get exposure to roughly 3,500 companies, ranging from massive titans like Apple, Microsoft, and Amazon, all the way down to small-cap innovators you've never heard of. Here is why I love this strategy. You don't have to call the winners. Think about NVIDIA. 5 or 8 years ago, almost nobody had NVIDIA AI chips on their bingo card. If you were picking individual stocks, you probably missed it. But if you held VTI, you owned it the whole time. As NVIDIA rocketed to the moon, you captured that growth automatically. It is the ultimate set-it-and-forget-it investment. Now let's look at the receipts. Over the past 10 years, VTI has returned an average of 14% per year. Let's do the math on that. If you had invested $10,000 10 years ago and did absolutely nothing, you would be sitting on roughly $37,000 today. On top of the growth, it pays you just to hold it. The current dividend yield is about 1.4%. So that same $10,000 investment pays you $140 a year in passive income. My advice? Just reinvest it and let the compound interest snowball. But the most critical number here isn't the return, it's the cost. VTI has an expense ratio of just 0.03%. That is basically free. Keeping your expenses low is just as important as getting high returns. Chapter 3. The Passport, VEA. However, if you stop at the US border, you are making a fatal error. In the investing world, this is called home country bias. You are betting your entire financial future on the economy of just one country. To protect yourself, you need a passport. Asset number 2 is VEA, the Vanguard Developed Markets, ETF. This ETF gives you ownership of roughly 3,900 of the largest companies in the industrialized world outside of the US. We are talking about Europe, Canada, Japan, and Australia. Let's look at what you're actually buying. The top holdings include companies like SAP, the largest software company in Europe. You also get ASML, which basically builds the machines that power the entire AI revolution. You get Toyota and Novo Nordisk, the company behind the Ozempic craze. Now, I hear the critics in the comments already, but the US market has crushed international stocks. And you're right. For the last 15 years, the US has been on an absolute tear. But markets move in cycles. If you go back to the 1980s or the early 2000s, international stocks actually outperformed the US. In fact, look at this year alone. VEA is up over 24% year to date. Compare that to VTI, which is sitting around 10%. If you only owned US stocks this year, you missed out on double the growth. This is why we diversify, to capture the upside no matter where it happens. For me, I keep about 20% to 30% of my portfolio in this asset. I prefer focusing on developed markets rather than emerging markets like China because, frankly, I don't always 100% trust the economic data coming out of some of those regions. I want stability. Plus, VEA pays a juicy dividend of roughly 2.6%. It's a nice cash flow bonus while you wait for growth. Feel like your hard-earned money is just evaporating? Tired of the same old system eating away at your future? Stop taking the thorny path. It's time to build your own financial fortress. I want to show you the smarter road to real security and growth. Don't wait for the sun to set on your dreams. Subscribe and let's start building your bright future today. Chapter 4. The Shock Absorber, BND. So far, we have built an aggressive growth engine. But the stock market is a roller coaster. It has high highs, but it also has terrifying lows. And when the market drops 30%, human nature kicks in. You panic. You sell at the bottom, and you lose everything. You need a shock absorber to smooth out the ride. Asset number 3 is BND, the Total Bond Market, ETF. I know bonds are not sexy, but they are the suspension system of your portfolio. BND holds about 11,000 bonds, split between safe U.S. government debt, about 70%, and high-quality corporate bonds, rated AAA to B. It specifically excludes junk bonds, so this is a safety play. Let's be real about the performance. Over the last 10 years, it has returned about 1.8% per year. If you put $10,000 in, you'd have about $11,900 today. Pretty May, right? But we don't buy BND for growth. We buy it for income and stability. Right now, BND is paying a shockingly high dividend yield of 3.77%. That means a $10,000 investment pays you $377 a year in cash. More importantly, it zigzags when the market zigs. When stocks crash, investors flee to safety. They buy bonds. This keeps your portfolio stable so you don't panic sell when it matters most. Chapter 5. The Wealth Accelerator, Real Estate. Okay, now that we are safe, let's talk about getting rich. Stocks are great, but if you want to accelerate your wealth timeline, you need asset number 4, real estate. You have two options here. Option A is the easy way. You buy a REIT like VNQ. It's basically a stock that owns real estate. It's liquid, easy, and passive. But option B, physical ownership, is where the real magic happens. In my heart of hearts, I believe this is the fastest path to wealth for the average person. Why? One word, leverage. Imagine you have $35,000. If you go to a bank and say, hey, loan me $1 million so I can buy Google stock, they will laugh you out of the building. But if you take that same $35,000 and say, I want to buy a $1 million multifamily property, they will often give you the money using a low down payment loan. You put up 3.5%, the bank puts up 96.5%, but you keep 100% of the profit. Think about the math on that. If you buy a property for $600,000 and it appreciates just slightly to $750,000, you have created $150,000 of equity. Because you use the bank's money to do it, your actual return on investment is massive. Plus, you get tax benefits like depreciation. The IRS lets you pretend your building is losing value every year, even though it's actually going up, which creates a phantom loss you can use to lower your taxes. And finally, it is the ultimate inflation hedge. When inflation goes up, the price of goods goes up. Housing is a good, so rents go up. Your asset value goes up. Inflation actually makes you richer. Chapter 6. The Bonus. Private Credit. Finally, for those of you who stayed to the end, let's talk about that bonus investment generating 11% returns. Private credit. This falls under alternative assets. Specifically, I invest in the Fundrise Opportunistic Credit Fund. This strategy is essentially acting like the bank. Instead of owning the building, you are lending money to the developer who is building it. Right now, big banks are terrified. They have tightened their lending standards, which means developers can't get loans. So they come to private funds like this one, and they pay a premium interest rate to get cash. This fund targets returns of 9% to 11%, and this year it is actually on pace for 12%. But there is a catch. First, you need to be an accredited investor. Second, it is illiquid. Once you put your money in, it's tied up for 5 to 7 years. And third, the fees are steep. About 1.75% management fee plus a 20% incentive fee on profits. That sounds high, but net of fees, you are still looking at an 8 to 9% return that is totally disconnected from the stock market. It's a powerful diversifier if you qualify. So there you have it. The Fortress Portfolio. VTI for US growth, VEA for the world, BND for safety, real estate for leverage, and a little private credit to juice the returns. You can keep gambling on penny stocks, or you can build the fortress. The choice is yours. If you learned something today, smash that like button. I'll see you in the next one. Peace.